Welcome to Shooting It Straight with Stan. I am your host, Stan the Annuity Man, America's annuity agent licensed in all 50 states. So glad you joined me for this topic, which is a good one. And it came from my good friend, John Lenz. I call him the annuity architect. If you're not familiar with John, you should be. He's one of the smartest people in the annuity room. And that is including myself. Big statement. But I do this Fun with Annuities podcast that you can find on all major podcast platforms. And John is a frequent guest on that podcast because he's so darn smart and he makes me look good. And anyone who makes me look good, I hang out with. You know what I'm saying? It's kind of like a lead singer, and you're like, and the lead guitarist is like Jimi Hendrix or Eddie Van Halen. That's John Lenz. Now, he and I were talking the other day, and he told me about a case, and I've seen these before, but it's worth us talking about. Me and you, of course, exchanging your income rider for a SPIA, a single premium immediate annuity. Now, that's a loaded statement. I mean, so we've got to dig in a little bit here because it's not that easy. In other words, I got an income rider, I'm just going to flip that thing to a SPIA. And you don't need an agent to do that either. It's got to mathematically work in your favor for that to happen. I'm going to go through that. But John told me a great case that he was working on, that they looked at the income rider, and in this case, it was attached to a variable annuity, and it can be attached to variable annuities or index annuities. But an income rider, just to give you a glance at that and what that is from a 30,000-foot view, that's an attachment to a policy, variable annuity or index annuity policy at the time of application, that guarantees a lifetime income stream. You can set up your life, joint life, etc. But it's a separate calculation from the accumulation value. I know I'm going fast. I'm going to stop. Accumulation value in real terms is the real money. In the variable annuity side, that's the separate accounts, meaning you call them mutual funds. In the indexed annuity world, that's the index option strategy, the caps and spreads and participation rates and that stuff. The walkaway amount. So if you draw a line down a blank sheet of paper, visually, left-hand side is the accumulation value side. Again, for variable annuities, it's the mutual funds, i.e. separate accounts, and the index annuities, these caps and spreads and participation rate, the index option side. And then the other side is the income rider, two separate calculations. And typically, the income rider is higher than the accumulation value. You say, wait a minute, why? Why you say that carte blanche, Stan the Annuity Man? Is because the annuity companies, annuities issued by life insurance companies, the life insurance companies, they want to keep your money, and the income rider is not transferable. That amount in the income rider side of the ledger is not transferable if you decided you wanted to transfer the money. Okay, so now we're getting to the meat of the matter. So how do you even determine if you can legally, morally, ethically transfer it to an immediate annuity? Here's what you have to do. You have to take the accumulation value of the policy, not the income rider value, the accumulation value of the policy, and you have to ask that company to give you two, that you're with currently, to give you two guaranteed contractual numbers. Number one, the income rider number of what that lifetime income stream would be, and number two, the annuitization number, the SPIA number, if you took that accumulation value and you converted it into a single premium immediate annuity, and most of these policies will allow you to do that. And then you go to my site at theannuityman.com. Obviously, you schedule a call with us. We'll walk you through this process, and you can run a single premium immediate annuity quote using the accumulation value, the walkaway amount. Remember, again, variable annuities, that's the separate accounts and the mutual funds, that value, and index annuities, that's the cap, spreads, and participation rates, index option value, that walkaway amount, minus surrender charges, right? And so you run that number on our site, Single Premium Immediate Annuities, our calculator there, and see what the number is. Now, in this case, what John was telling me is the income rider number. They looked at the income rider number, and the single premium immediate annuity number, quoting all carriers, beat that number using the accumulation value. Unbelievable, okay? That's incredible. Shouldn't happen, but it did. And it was a big case, and it was in the client's favor. I mean, it was a huge difference between the guaranteed lifetime income rider amount that the variable annuity was offering and the single premium immediate annuity using the accumulation value, not the income rider value, to quote it. Here's what it all comes down to. Annuities are math. And when you do a transfer, and by the way, let's talk about transfers for a second. If you have the annuity, variable or index annuity, the income rider inside of an IRA, it's an IRA to IRA transfer. It's a non-taxable event. If it's in a non-IRA account, it falls under IRS Section 1035. Look it up if you're so bored. And that says you can transfer from one annuity to another non-taxable event. So in any case of transferring annuity to annuity, it's a non-taxable event, but it's bigger than that. The annuity industry does not want agents and advisors out there what they call flipping and churning and twisting accounts, meaning they're transferring it to create a commission for the agent or advisor. The annuity industry, whatever you think about it, whatever you think about the annuity industry, they really do care about the consumer. They're trying to thwart, love that word, which means stop in Southern, stop all that nonsense. So what do? You say, wait a minute, that sounds good in principle, but what the heck, what kind of policies or what kind of best practices are they putting in place? Well, here's what they do. When you transfer from one annuity to another, doesn't matter if it's IRA, Roth IRA, non-IRA, the application has a side-by-side comparison of the annuity that you're coming from going into the annuity that you're going to. And the annuity that you're going to has to provide, wait for it, a higher contractual guarantee, not a hypothetical, not a theoretical, not unicorns chasing butterflies, a higher contractual guarantee when you move from the old annuity to the new annuity. So in this case with John, he had to show to the receiving annuity company that not only was the income rider amount not higher than the single premium immediate annuity amount using the accumulation value, but also the single premium immediate annuity quote from the old carrier wasn't as high as the SPIA quote quoting all carriers. He had to prove both of those. Okay? You say, well, wait a minute, that's a lot. It is a lot, and it should be a lot. There should be huge hoops to jump through before you make a decision to move from one annuity to another, knowing that the income rider value is not transferable, knowing that the accumulation value, if there are surrender charges, you got to factor that in. And there's no games to be played. And if there's games played by the agent or advisor filling out the application, that's a whole nother problem that the agent and advisor is going to have to deal with, and they ain't fun. It ain't fun. It's lose your license, see you later. And it should be. It's like filling out a mortgage application fictitiously. I mean, there's no way to juice the numbers on a side-by-side contractual guaranteed comparison. So what? Okay, Stan, that's fantastic. I get it. So what now? If you have an income rider, if you've purchased a variable annuity with an income rider or an index annuity with an income rider, then I would encourage you to go to my site at theannuityman.com and schedule a call. It says book a call in a big, I think it's a yellow box. I'm kind of colorblind, yellow box. And you'll either get me or one of my smarter people on the phone, and we can do that side-by-side comparison. Spoiler alert. Most, and I say the majority of the time, I would say over 70% of the time with income riders, you're not going to be able to beat it by transferring the accumulation value, the walkaway amount, the real money amount, to an immediate annuity quote in all carriers. You're just not. But you know what? Isn't it worth the exercise? Isn't it worth you looking at your income rider that you've had in place, you've been paying fees on it every year, and you're going to pay fees on it for as long as you're breathing, just to make sure that you have the highest contractual guarantee? Makes sense to me. It's like having an income warranty, right? And we are providing it at theannuityman.com for free and under no obligation. All we're going to do is run the comparison and tell you, hey, you stay there. Stay 70% of the time we're going to say, hey, that's good. I'm glad we did this. Now you know, stay there. Turn on the income rider when you need income, period. But You might have the situation that John Lenz ran into, one of his valued clients, that says, hey, this income rider is not competitive when it was written, and we can do better with a lifetime income guarantee with a single premium immediate annuity. Now, if that's the case, that's a pretty good deal, because what are you doing? Good question. If you transfer from the variable and index annuity to the income rider to an immediate annuity, after we have proven that the contractual guarantees are higher with that single premium immediate annuity, now you've stripped out all those fees. I'm not saying the fees are bad for income riders, because it doesn't affect the lifetime income stream, but you are paying a fee for the life of the policy for that income rider attached to variable or indexed annuities. If we can mathematically and contractually show that you're going to get a better and higher payout, apples to apples, move into an immediate annuity, you've also stripped out all fees. All fees. Now, income riders typically, 99% of the time, are what I call life with cash refund, meaning that when you pass away, whatever's left in the accumulation value will go to your list of beneficiaries. And the evil life insurance and annuity company won't keep a penny, even though they're contractually on the hook to pay as long as you're breathing. What we typically do in an apples to apples comparison is run the single premium immediate annuity life with cash refund, or joint life with cash refund, to mirror, M-I-R-R-O-R, mirror the income rider that we're comparing it to. Okay, I know I threw a lot at you. That was a fire hose of Annuity Man information, but very valuable to all of those income riders that were sold out there. And a lot of you are not sure what they are, not sure what you bought, not sure if it's good, why am I paying this fee, et cetera, et cetera, et cetera. What we want to do at the Annuity Man is clarify that so that you don't have to think about that anymore. And like I said, 70% of the time, we're going to say, you're good. Stay there, you're good. You can't beat it on the street, as they say, the annuity street. Stay where you are and turn on the income rider when you need income. But there are going to be those situations like John Lenz ran into, that we can actually beat the income rider using the accumulation value in a SPIA, single premium immediate annuity, quoting all carriers. How about that little nugget of wisdom? Unbelievable. From Stan the Annuity Man. And that is Shooting It Straight with Stan. I'm Stan the Annuity Man, America's annuity agent. I'll see you next time.